Good day, everyone. Welcome to our confidential report for the 5th of May, 2021. I'm going to begin in America, as I usually do. GDP in America grew by 6.4% in the first quarter of this year, which is much faster than was expected. This shows that the American economy is starting to really move now, obviously as a result of the considerable stimulation that has been administered to it, both fiscally and from a monetary point of view. GDP reached $19.1 trillion in the quarter on an annualized basis, which compares with the $19.3 trillion which it reached in December 2019, in the December quarter of 2019, before the COVID pandemic, which shows that America is almost back to pre-COVID levels. The growth is coming from motor car sales, food and beverages, and also restaurants, so it's coming in across the board. Obviously, confidence has been boosted by the $1,400 checks which Biden sent out, and also the rapid rollout of the vaccination program. House prices have also been rising in America as interest rates are close to zero. Unemployment has fallen back to 6% and should be close to 4%, I think, by the end of the year or early next year. The 2.4% contraction in 2020 was a V-bottom, as we predicted in March of 2020. The S&P is rapidly recovering. As you can see on your screen here, you can see we made a record high on Thursday last week at 4211, and that's up 4.77% since the last confidential report just 1 month ago. The gains have been fueled by massive fiscal and monetary stimulation, but obviously that cannot last forever. So if we look back over the record, we can see that from the high, this was a record high here pre-COVID, the market fell 34% to this low point here at 2237, which occurred in March. And then since then, the market has gone up by 88%. So that's quite an amazing recovery. And it's now 25% above this pre-COVID high. We are expecting a correction of some sort, of course. It may already be beginning. Nothing in the share market moves in a straight line, so some sort of correction seems inevitable, probably between 10 and 20%. But we believe that that will be a buying opportunity and not the beginning of a bear trend. It will be touted as the beginning of a bear trend, but we don't think it will be. We think you should therefore look at it as a buying opportunity. Of course, eventually, we have discussed this before, but eventually there will be the mother of all bear trends. And that will be caused by rising U.S. inflation and inflation fears. That will be the early indicator. But this coming correction, we do not believe will be the beginning of that bear trend. Inflation is still around 2%, but is expected to tick up to about 3% this year, towards the end of this year. The U.S. Consumer Price Index has been moving up in small increments over the past 4 months. It's now the highest in March. March month saw inflation rise by 0.6%, which if you annualize it is 7.2% per annum. But of course it won't continue for a whole year. So inflation is basically at about 3.2% in America at the moment. Part of the reason for that is the rising oil price. And let's have a look at that chart because that's quite important to us. You can see here oil is on the rise. The petrol price in America jumped 9% in March month this year. And that will obviously lead to some secondary inflation as the petrol price filters through to other industries. The yield on the U.S. long bond has also risen. So that's the 10-year Treasury bill has risen from 0.5% in April last year to about 1.5%. So there's rising yields. In the past, the yield on that long bond has been a very accurate indicator of rising inflation. And of course, if inflation is going to start moving up, then the Federal Reserve Bank will have to react at some point. And they will react, of course, by raising rates. Initially, at first, raising rates will not have a big impact on Wall Street, but we believe that sooner or later it will impact Wall Street. So inflation may also surprise on the upside. We may see much faster rise in inflation than is generally expected. Our view is that once the inflation genie is out of the bottle, it cannot easily be put back into the bottle. So we see rising inflation as inevitable, and the response of the Fed will be to raise interest rates, and that will have a negative impact on the stock market. It's only the timing really that is unknown at this stage. But that process is probably going to almost certainly happen. All right, so that's America, and we're looking at some interesting things there in America. Let's turn our attention now to South Africa. We've had a lot of developments on the political side in this country over the last month. And I know that this report is not really about politics, but sometimes politics does impinge on the stock market. We've heard a lot of talk about this concept of radical economic transformation. So I've put it into the glossary, and I've included an article that I came across which explains it quite well. But radical economic transformation basically means widespread nationalization of key industries like mining, the banking industry, and so on. It is effectively a major step towards a socialist system and away from the mixed capitalism which South Africa currently has. It is a radical populist ideology. I suggest you have a look at that article. It'll give you a good idea of where we're coming from here. It ignores the fact that most government-run organizations in South Africa have been expensive failures. And of course, I refer you to Eskom, the Post Office, SABC, Denel, and just to name a few of them. President Ramaphosa has said quite clearly no ANC member should associate themselves or be involved with radical economic transformation. But Ace Magashula, who's still the Secretary General of the ANC for a day or two more, has openly said that RET, radical economic transformation, is the policy of the ANC. On Monday, the NEC, the ANC's highest body, supported Ramaphosa unequivocally in saying that Magashula must step down as Secretary General of the ANC, and if he doesn't, he will basically be kicked out. This is a major victory for the Ramaphosa camp. It forces Magashula to adopt a strategy. He must either start his own party and operate within the constitution, or he must begin a revolution, basically. I think that he's not a particularly good organizer and that nothing much will eventually come from this. But there's no doubt that Ramaphosa has been strengthened by it. There's also almost no doubt that Magashula has been a key agent of state capture and has been involved in corruption. While we're on the subject of that, the Judicial Conduct Tribunal found that Judge Hlophe was guilty of gross misconduct, and that's again a victory for the Ramaphosa camp and for the judiciary. Ramaphosa's strategy has remained the same: let the system deal with his enemies. He never gets directly involved or comments himself. Of course, it will take a 2/3 majority in Parliament to get Hlophe out, which might be achieved with the help of the DA, with a bit of luck. Of course, municipal elections are coming up on the 27th of October. The date has now been set. That is obviously going to be very important from a strategic point of view. Cyril Ramaphosa has been urging voters to vote against corruption, and he's looking for a strong vote of confidence and a mandate from that election. It appears that he is gradually gaining ascendancy in the battle with the Zuma camp. Magashula and Zuma are both now facing serious legal problems, and their attention is probably taken away from the battle for control of the ANC. And Ramaphosa's domination of the ANC can only be good for the JSE in the long term, in our view. Right, let's look at the economy. The Monetary Policy Committee says that the economy is recovering much faster than expected. It's undergoing a K-shaped recovery, which means that some sectors are doing well, while others have been almost destroyed. The mining industry is obviously doing well, riding on the back of rising commodity prices, while the IT and the social media sector is also doing well because of increased online purchases of products and work from home and online conferencing and so forth. The hotel and tourism industry has been badly damaged and will probably take at least a couple of years to recover. Office property is also being damaged and will take some time to recover, while residential property has apparently done well. And we see that the property index is moving up quite strongly and looks to be in an overall recovery. ABSA has raised its GDP growth rate from its expected GDP growth rate for this year to 3.8% from 3.1%. We still think that that is conservative, even at 3.8%. ABSA says that half of Eskom's debt, that's about $250 billion, will have to be moved onto the government's balance sheet. In other words, the Treasury will have to take responsibility for it. Our economy is still threatened by a third wave of the virus, but the level of infections appears to be fairly stable at below 1,200 per day. The Easter holiday did not have the feared impact that we all expected, and if we get a third wave, it may take some time to develop. Discovery says that more than half of South Africans have had COVID and therefore have some degree of immunity. This is good news, because if it's true, they will be virtually impervious to getting the virus at this stage. The consumer price index for March was up by 0.7%. If you annualize that, it's 8.4%, which is well above the Reserve Bank's target range. But of course, it won't be sustained. It's just a once-off in March. The true inflation rate is around 3.2%. The producer price inflation is also up at about 5.2%, which shows that the economy is recovering. The main CPI contributor is food and beverages, not fuel. But of course, we've had the 15.63% rise in Eskom's prices, and that will inevitably impact the PPI sooner or later. Inflation at the producer level is sometimes carried through to the consumer price index, but that is still well below the midpoint of the Reserve Bank's target range between 3 and 6%. Our governor of the Reserve Bank, Letsetsa Kanyago, says that rates are likely to remain unchanged this year. We think that they will remain unchanged until the middle of next year. The unions, of course, have rejected the government's cost of living offer, but they have agreed to allow the government time to reconsider, which is, in our opinion, a sign of their weakness. A deadlock has been declared in their dispute, and if that's unresolved for 21 days, then they will declare a dispute, and then after 14 days from that time, they can start to strike. We have long said that a confrontation between the government and the unions is inevitable, and this is probably what we are looking at right now. In the meantime, Mr. Kieswetter, who's in charge of the South African Revenue Services, says that SARS is recovering from state capture, and this means better revenue collections, starting with a 38 billion rand collection above the February budget, which is very good news, and also a 28% improvement in taxpayer compliance, which is also good news. The large business unit has been re-established. So from our perspective, Kieswetter is doing a great job, and it fully justifies the extra 3 billion rand which was supplied to SARS in terms of the February budget. Throughout Africa, governments have failed to collect tax effectively, and this has eventually resulted in them sinking into debt. And then once they could raise no more debt, they started printing money, and that led to the collapse of the currency, and that, of course, led to a complete drying up of foreign direct investment. This has been the process in Zimbabwe and a number of other countries. Over the 27 years that the ANC has been in charge here in South Africa, we have so far avoided this disaster. Debt levels have certainly worsened in the past 12 years due to state capture, but there has been no printing of money. Now South Africa has the strongest emerging market currency following the COVID-19. Kizweta is clearly a key component of the recovery at SARS. One other good piece of news is the agricultural season that we've had. We've had 16 million tons of maize produced this year. It's the second largest crop on record. It's a massive boost to the economy because it means that millions of subsistence families can grow sufficient maize to eat and maybe even create a small surplus. They're therefore not reliant on state handouts, and it means that they can recover somewhat from the ravages of COVID-19. South African consumption of maize is usually around 11 million tons of maize per annum. This year we can export 4 million tons, maybe more, and earn foreign currency. So the rains are really a vital factor in the progress of the economy and also the level of inflation in this country. Let us turn our attention now to the rand, which has been looking pretty good recently. Here you can see my chart of the rand, and I'll just run through it again quickly. You can see there's support at 15 Rand 30 to the US dollar, resistance at 14.40. Okay, and here you can see the impact of COVID-19 in March last year, and then how the rand has been strengthening since then. This is the period during which the US elections were running, so that was a period of uncertainty, which was resolved positively with Biden's win. And then the rand came down to find these levels down here, and we predicted a clear breakthrough this resistance at 14.40, which happened. But the rand is now weakened again to come back up to that 14.40 level. So the level that was resistance has now become support, which is quite a normal thing in technical analysis. But it is important to understand that. In our view, the rand is basically undervalued against first world currencies. And once all the external factors are removed, like, for example, COVID-19 and the impact of other emerging markets, the rand should strengthen. We continue to believe that it will strengthen through 14.40 and continue on a stronger path. As the world recovery becomes clearer and clearer, you will find that overseas investors become less risk averse and they look for high levels of real returns, which South Africa can offer through its bonds. Cash is flowing into the country and the rand is strengthening. We are obviously also benefiting from the ongoing boom in commodity prices. Okay, so the South African rand is the only currency amongst the emerging market currencies that is up against the US dollar so far this year. It also briefly broke through the 20 rand to the British pound the other day, which was good news. I've got a few general points that I'd like to make at this stage. BMW has called for the government to motivate the use of electric vehicles because obviously the whole industry is moving towards electric vehicles. Most European countries have established a rule that there will be no internal combustion engines after 2030. South Africa will have to upgrade in order to keep manufacturing, and that means basically that we've got to start upgrading our service stations so that they can do recharging of electric vehicles. The COVID-19 passport is becoming a reality. Obviously, it is very helpful to gain entry to other countries without going through quarantine. Also, I think it will be used extensively for gatherings where people are gathered in crowds. They will only be allowed into those venues when they have a COVID passport. So restaurants and churches and other large gatherings. The next step is this advent of the COVID passport is probably the next step in normalizing the world economy. Of course, the anti-vaxxers will suffer and probably will change their minds for the most part. A new study in South Africa shows that online retail is up from 2% where it was before COVID-19 to around 5%. MasterCard says that about 68% of South Africans have now done online shopping for the first time. Patronage at shopping malls is unlikely to ever return to pre-COVID-19 levels. All the big retailers have been forced to adapt and to develop their online shopping ability. Water management in South Africa is becoming critical. 41% of water is now lost through leaks. Fresh water is polluted by effluent because more than half of the country's waste treatment plants have failed. It will cost about R1 trillion in the years up to 2030 to fix the water system. And a new water council has been established to do this. Hopefully this is not just another highly paid but useless bureaucratic institution, and that it will actually achieve some effect in the water industry. The conflict in Eskom between Eskom's Chief Procurement Officer Chitangano and the CEO Director is typical. Chitangano has been suspended for incompetency, and now he's using that to attack Director as a racist. The courts will eventually decide what is to be done here, but we think that Chitangano will probably lose his job. That will be the outcome. Certainly we hope so. Sasol and Air Liquide, which is a French company, are building a 900 megawatt solar park to provide electricity to Sasol plants. This will cost about 13 billion rand and will be by far the biggest renewable energies facility in South Africa when it's completed. Obviously, Sasol is trying very hard to improve its carbon footprint and its carbon image in the world. But in fact, the impact of this 900 megawatt plant on Sasol's carbon footprint will be relatively negligible. Let us turn our attention now to commodities. Obviously, the rapidly recovering world economy continues to benefit commodities. SA is benefiting directly with mega profits and also, of course, rising tax collections, which is helping the fiscus. It's helping us to recover from state capture and from COVID-19. The gold price, on the other hand, has been falling. And we just look at that chart there quickly. Okay, I'm just going to put a bit more data on the screen here. You can see here gold reached a peak over here at just under $2,000 per ounce, and since then has been trending down, and to the point now where it's about 13.5% down in dollar terms and about 30% down in rand terms. Neil Froneman, the CEO of Sibanye, is now looking around for more acquisitions because he thinks that some gold shares are underpriced as a result. He believes that gold will move higher in time, and we think he may well be right. Obviously, the massive stimulation of the American economy and 0% interest rates must sooner or later result in rising U.S. inflation, and that will be true for the rest of the world as well. Gold is a hedge against inflation. So this is probably the logic that he's following. The iron and steel industry is booming at the moment because of the steady recovery in the world economy, and the demand for iron, especially from China, has been very strong. Iron is now trading for over $190 per ton. Steel is expected to rise by 6% during 2021, and this clearly benefits the South African economy. Okay, let's have a look at a few companies now. I'd like to just begin by looking at the property index. The property index obviously took a hell of a pounding over the last couple of years. Just want to put a bit more data on here. There you can see, well, let's go to 2 years, I think. Here you can see how the COVID-19 finally brought the property index down to its lowest point in March last year. And since then it has been moving sideways, but it has recently broken to the upside, which is something we predicted. And we think that there are quite a number of property companies that look like they are very good value at the moment. And we're expecting this sector to move into an upward trend, except for the office properties, but where vacancies are about 15% and expected to rise to 20%, but mainly because of the work from home ethic that has taken over now. So the property sector we'll look at in more detail in a moment. Then I just wanted to look at Bitcoin briefly. It's been in the news quite a bit recently, ever since Elon Musk decided to invest $1.5 billion in Bitcoins. We've had a very strong run-up in the Bitcoin price. But what we're seeing here looks like a head and shoulders formation. I don't know if you can see it. Here's the left shoulder, there's the head, and now we've got a right shoulder. If this breaks down through the neckline, it would be technically quite negative for Bitcoin. And you have to remember that we cannot analyze Bitcoin from a fundamental perspective because there are no fundamentals. So we have to work with technicals. It's the only thing we've got. So we believe that this may be a problem, that this might be a head and shoulders formation, and that there could be some significant profit taking coming up. Our advice remains, if you don't have them, don't buy them. And if you do have them, sell them. Okay, a while back we recommended Afrimat as a share for you to get into. In fact, on the 25th of May last year, we suggested that you get into Afrimat. Here you can see we wrote an article there on the 25th of May. Since then, the share's gone up about 67%. It was 29 Rand when the article was written. And now it's trading at around 47 Rand, 46, 47 Rand. And in their trading statement, which has just come out for the year to the 28th of February, they said that headline earnings per share would be up between 22 and 32%. So that's a fantastic jump for their profitability. We think this remains a very good share. Okay, those property shares we were talking about earlier, Fairvest is the first one we'd like to suggest. They've got a loan to value of 32.2%, which is very good for a property company right at this time. Here you can see that after COVID-19, the shares entered a new upward trend and is moving up quite nicely. This company specializes in rural and out-of-town shopping malls, mainly aimed at the lower income levels, the lower LSMs, and it's been relatively COVID immune, and it looks good to us. Another property share to look at is Spear. This company has started to move up really strongly now, and you can see again here there's a strong fall at COVID. It found support down here at 490 cents, but there's now a strong upward move, and we think that will continue. In their trading statement for the year to the 28th of February, they said that they had managed to collect 97% of rentals and that they had occupancy at 94%. And we think that this is one you should certainly be looking at. Another share that looks interesting at the moment is MTN. MTN has taken quite a pounding over the months because of the problems it has had in countries like Nigeria. But now it appears to us to be doing quite well. And what I'd just like to point out here is the relative strength of MTN against Vodacom. Vodacom is obviously the alternative share that you could buy in the mobile phone industry. And you can see here at the bottom of this chart, the lower half is a relative strength. Relative strength chart is drawn by dividing one share price by another. So in this case, we're dividing MTN's share price by the Vodacom share price and drawing a chart of the result. As you can see, that division, that relative strength, is moving up steadily in favor of MTN. In other words, MTN is outperforming the Vodacom share price steadily at this stage. And we think that this is a good share. In their latest results for the year to the 31st of December, MTN said turnover was up 20% and headline earnings per share jumped a massive 60%. So this is one to look at. Finally, I'd like to just look at Coronation. I have been interested in Coronation for a long time, and just like to go back, and in fact even further back. You can see that Coronation made a peak in 2014, in December 2014, at 115 Rand per share up here. That was stimulated by some window dressing at the end of 2014 on the 31st of December. Window dressing is something that the big institutions do where they buy up shares on the last day of trade because last day of trade is very thinly traded, and most people are away on holiday. So the 31st of December, they buy up the share and drive the price up to higher levels. And the effect of that is that it improves the performance of their portfolio. But after that peak in 2014, Coronation fell steadily to this low point down here at about 25 Rand following COVID-19. Since then, it has staged quite a nice recovery. And it's obviously one of South Africa's biggest fund managers. It manages 629 billion Rand as at the 31st of March. And we see it now as being relatively good value on a dividend yield of about 5.5%, and we expect it to continue rising. Ladies and gentlemen, that's what I have for you this week. I hope that you found something of interest, and we will talk again on the first Wednesday of next month. Thank you for listening to me.